Good day, everyone. My name is Joyce Alinas, a BS accounting student. Now, I will present to you about an audit program for my selected topic, which is the investments. So, what is investments? Investments is the deployment of capital in order to earn interest, dividend, or capital appreciation. Investments are basically either held to maturity or available for sale securities. Held to maturity securities are those that are held with intent until maturity. These are reported at cost provided an amortization and accretion of discounts. Available for sale investments are reported at fair value, where any unrealized profit or losses form part of stockholders' equity. While auditing the investment of any entity, the auditor needs to be aware of applicable accounting guidance. They should be familiar with the knowledge of client businesses and the nature of investment it holds. So here are the audit assertions necessary for investments. First is the existence. Investments reported on the financial statements really exist at the reporting date. The second one is the accuracy and valuation, where investments balances truly reflect their actual economic value at reporting date. The third one is the completeness, where all investments that should have been recorded have actually been recorded. Where the next is the rights and obligations. The client has ownership rights for all investments as of the reporting date. And the other one is the presentation and disclosure. Investments have been properly classified and appropriately disclosed into the notes to financial statements. Now I will show you my whole document about the audit program for investments. So let's start with the uh, prior pages, which shows the audit entity, the entity name, the project name, the time period allotted for the audit, at, as well as the budgeted time given by the management. This includes the name who prepared, checked, and approved with their initials and signatures. This presents also the audit team, which consists the audit manager, the team leader, and the auditors. The auditors who works on this paper or who works on these audits. So investments can be account balances in investments includes in investments in subsidiaries and associates, investments held to maturity, available for sale, or held for trading. So there are different classes of transactions of investment, which is the dividend, interest, the gain or loss on revaluation, and the gain or loss on disposal. So auditing the investment account had the following audit objectives. First is to investments are completely and accurately recorded, which test the assertions of completeness and the accuracy of the account. Where all recorded investments are actually exist, test the existence. Where all investments are appropriately valued, test the valuation of the amounts. Then all investments are owned by the client and title is also in the name of the client. This check the rights and obligations of the client. So this div- the dividend and interest income, gain or loss on revaluation, and gain or loss on disposal has been accurately calculated, completely recorded, and appropriately disclosed. This check the occurrence or the existence. Yeah, these check the occurrence or the existence, the completeness, the accuracy, and the presentation and disclosure of accounts. And the lastly is the investments are presented and all disclosures have been given in accordance with the fourth schedule of the company's ordinance with the relevant PAS or PSA standards. So this tests the occurrence, the completeness, the accuracy, the presentation and disclosure, the rights and obligations, as well as the evaluations. According to PSA 510 number 2, for initial audit engagements, the auditor should obtain sufficient appropriate audit evidence that the opening balances do not contain misstatements that materially affect the current period's financial statements. The prior period's closing balance have been correctly brought forward to the current period or when appropriate have been restated. And lastly, the appropriate accounting policies are consistently applied or changes in accounting policies have been properly accounted for and adequately disclosed. For gathering and audit evidence, this requires different kinds of audit procedures. So here are the audit procedures of investment account. But before that, let us know first the sufficiency of evidence that we will be going to obtain. So, according to PSA 510 number 4, the sufficiency and appropriateness of audit evidence the auditor will need to obtain regarding opening balances depends on such matters as the accounting policies followed by the entity, whether the prior period's financial statements were audited, and if so, whether the auditor's report was modified, the nature of the accounts and the risk of misstatements in the current period's financial statements, and the materiality of the opening balances relative to the current period's financial statements. This is the following audit procedures that is necessary to gain or gather evidences of uh, the audit. Audit procedures are necessary to obtain the objectives of attaining all the necessary assertions to be met. In test of control, for example, some audit procedures of testing of controls are number 1, assess the reasonableness of design of system of internal control by inquiring relevant client personnel and documenting the same. If not, a documented system manual has been developed by the client. A walkthrough test would be necessary to confirm the understanding, a document, identify the preventive which exercised before incurrence of transactions in the event, and detective were exercised after incurrence or transactions of and event. Controls established by management to support its assertion. This attain the objective of all assertions, which is the existence, occurrence, valuation, accuracy, the presentation, disclosure, and so on. So another example of audit procedure testing of controls are check on sample of selected transactions covering the whole period that all preventive controls are exercised on all transactions. So these also cover all the assertions which test the accuracy, the existence, the valuation, and the presentation of transactions. This procedure is necessary to identify if the management take actions to prevent some necessary risk to happen or some possible fraud to occur in the management. So, after the test of controls, we have the analytical procedures. This includes document logical commercial reasons for major additions and disposal made during the year. This attain the objectives of testing the accuracy of the transactions. Next is compare current year balances and income with last year amounts and ensure that any significant variation should be properly and logically reasoned. This tests the completeness, the existence, and the accuracy of the transactions. Next to analytical procedures are the test of details. The example of audit procedures under test of details are number 1, obtain a movement schedule of investments, which is the shares, the TFCs, and the PIBs, both for numbers and amounts. These check the completeness and the existence of the transaction. Another example of this test of details is the trace the opening balances from the general ledger, subsidiary records, and the last year working papers. This is a necessary audit procedure to avoid any misstatements and to check the completeness assertions of the transaction. Another important audit procedure under the test of details are the tracing the carrying value of selected investments to supporting documents. Examples, the broker's notes for investments purchased in the current year, the confirmed date of purchase description and the number of shares, as well as the carrying cost in our prior year's working papers. These test the validity of the existence of these transactions. Also, under the test of details, for selected investments, compute the market value as under for quoted investment, trace market value from independent published quotations, or for unquoted investments, calculate the breakup value of shares from respective companies' financial statements. These check the valuation assertion of the transaction. So, last sentence or last audit procedures under test of details are: we have to ensure that investments are presented and all disclosures have been given in accordance with the fourth schedule of the company's ordinance and relevant PSAs. As per International Accounting Standards 39, all investments should be properly classified and held for trading or per available for sale and held to maturity, as they have to identify the value to be based in market value or at cost. This tests the occurrence or the existence, the completeness, the accuracy, the rights and obligations, the valuations, and the presentation and disclosure of the transactions or the amounts. So under investment income, we have to test this. For example, we have to obtain a schedule showing opening and closing balances of accrued income and income earned and receiving during the year. This is to test the completeness and existence of the transaction. Next one is we have to trace opening balance of accrued income from general ledger or trial balance. This tests the completeness. Let's select this. We have to make selection of accruals and examine documents supporting the amounts of investment income. For example, the rates, published quotations, and the dividends warrants. This tests the existence of the transaction. So for the last one, we have to ensure that closing balances of accrued income and working papers agree with general ledger. So um, that was the short presentation of audit procedures necessary for the investment accounts. So also we have to highlight that we have to indicate the person who conducted these procedures with the reference. So at the end of the audit, we have to conduct or we have to make a concluding part. We have to give conclusions or recommendations to the client. So here are some examples of information that we have to answer after the audit. So, number one, amounts and other data relating to investment transactions and other events have been recorded appropriately. So, if yes, let's check yes, and no, let's check no, and other references have will be put in here. So, the second one is transactions and events have been recorded in the proper accounts. Financial information is appropriately presented and disclosures are clearly expressed. So, if positive also, let's put check on the yes, and if it results a negative, then let's check the no. So number three, all transactions and events that should have been recorded, and all record disclosures have been included in the financial statements. Number four, transactions have been effected in compliance with relevant laws and legislations and regulations, compliance with prescribed standards in terms of disclosure of investments. So, transactions and events have been recorded in the correct accounting period. Transactions and events have been recorded and disclosed have occurred and pertain to the entity. And lastly, but uh, this was not the all, or the conclusions was not limited up to these statements, but these are only few examples. So transactions or events relating to the acquisition of shares and investments have efficient and effective use of resources. So auditor will also provide recommendations or a qualified opinion or disclaimer opinion about the whole audit of one entity. Let us now proceed for some illustrative examples. So we have here some problem. At December 31, 2007, Maria Angela Corporation had the following investments that were purchased during 2005, its first year of operation. So presented the different trading securities at their cost and fair value. So this presented security A, security B, C, D, E, and F. So no investments were sold during 2007. All securities except security D and security F are considered short-term investments. None of the market changes is considered permanent. So after the result of your audit, we have to determine the following: the amount of investment to be recorded as current asset, the amount of investment to be recorded as non-current asset, the unrealized gain or loss component of income before taxes, and lastly, the unrealized gain component of shareholders' equity. So uh, for the requirement number one, where we are required to get the total investment to be recorded in current assets, we have the security A recorded at their market value, the security B recorded at their market value, the security C recorded at their market value, and as well as the security E recorded at cost. In total, we have the 2,455,000, which is the letter B. So let's go back and see. Here it's letter B, the 2,455,000. The next one is we are about to compute the amount of investment to be reported as non-current assets. So non-current assets, we have the security D recorded at their market value, and we have the security F recorded at cost, which is classified according to the standard, where held at maturity to be recorded at cost, and available for sale investments or securities will be recorded at fair value. So in total, we have the 1,277,000, or the letter C. So let's go see the problem. So at letter C, the 1,277,000. So how much is the unrealized gain or loss component of income before taxes? So let's see. We have letter A, the 15,000, which um, consist of the solutions where trading security at cost 910 and trading security at market value is 925. So we have a holding gain of 15,000. So the question number 4 is the unrealized gain or loss component of shareholders equity. Oh, so number 4, we have the available for sale security at cost 1,350,000. Available for sale security at market value, we have the 1,425,000. So we also have a holding gain of 75,000 pesos. So it is necessary to ambot bitaw joke. So, to avoid any misstatements in the appropriate valuation, it is necessary to record the amount at its correct value depending on its class. So, held to maturity investment should be recorded at cost, and available for sale security should be recorded at fair market value, where profit and losses form part of the equity. According to PSA 510 number 11, audit conclusions includes: if after performing procedures including those set out above, the auditors is unable to obtain sufficient appropriate audit evidence concerning opening balances, the auditor's report should include a qualified opinion. For example, where the qualification covers the balance sheet, income statement, and the statement of cash flow. So or B, a disclaimer of opinion, or C, in those jurisdiction where it is permitted, an opinion which is qualified or disclaimed regarding the results of operations and cash flows as unqualified regarding financial positions. So, in statement number 12 to 14. So, if the effect of the misstatement is not properly accounted for and adequately disclosed, the auditor should express a qualified opinion or an adverse opinion as appropriate. So, also, if the current period's accounting policies have not been consistently applied in relation to opening balances, and if the change has not been properly accounted for and adequately disclosed, the auditor should express a qualified opinion or an adverse opinion as appropriate. However, if a modification regarding the prior period's financial statements remains relevant and material to the current period's financial statements, the auditor should modify the current auditor's reports accordingly. So that's all. Thank you for listening and God bless.